Hello, everyone. Happy Tuesday. We are live today to talk about the tax advantages of retirement plans. So looking forward to working through this today and sharing some information with everyone about how they can utilize their tax plans to their advantage, going through some different strategies and things of that nature. So we will go ahead and begin as always, first with our required disclaimers. Information in this material is not intended as tax, investment, or legal advice. Please consult a professional for specific information regarding your individual situation. All right, got that out of the way. Hopefully Jacob will be able to join us. He called me about 4:15 with an emergency. So hopefully he can jump on the stream a little bit later and we can see him participate. But at any rate, I do have some of his materials to share, so we can go through those. So today, what we want to go through is retirement tax plan strategies. For small business owners, we'll start off talking about the types of plans, contribution limits, plan design and features, startup credits that are available to you from a tax perspective. After that, we'll talk more specifically about strategies. When people have a ton of profit, what do they do now? We'll get into the qualified business income deduction, how to take advantage of that. On our athletes and entertainers side, they have some special rules that relate to personal service corporations. So they're able to do a couple things that normal people cannot do that is to their advantage. So we'll talk about that. Fees and payments, how are your clients paying, or if you're a small business owner, how are you paying your fees? Are they through planned assets or direct payment? Those things make a difference. And then at the end, how do we get started? What things should I be paying attention to get started on taking advantage of some of these tax savings? And then what we do on our end to help you. So we'll go through a lot of that information today throughout the class. So let's jump right into it. First, let's begin with kind of an overview of the different plan types. So here you can see on the screen, we've got these are the first four here are kind of the more prevalent for businesses with larger entities. So the 401k, which many of you all are familiar with. Let's see if I can make this a little bit bigger. The 401k that everyone's familiar with, the Safe Harbor 401k, defined benefit and profit sharing. I'll touch base on these from a overview and what their advantages are. These documents I have, I'll be glad to get them out to you. I'll post them or email them to you directly so you have them as a reference, because they do give you a little bit of information on target market. Where's it best to use these for your clients or for yourself? So a 401k is generally just a good old straight retirement plan. The biggest drawback to that one becomes if all of the employees aren't participating. As an owner, you can run into some limitations on what you can participate in due to the testing rules. And so that's why, again, plan design becomes important in terms of making sure you can take advantage of the rules. So for instance, in a traditional 401k, if you want to max out the return, max out your contributions, in this case, this year's 22.5, $7,500 catch-up contribution for those over 50. In order to max that out, you have to meet some testing rules on the back end in order to make sure that the IRS says it's okay for you to contribute that amount of money. If you don't meet those rules, they can come in and say, hey, the plan is what we call top heavy. It's benefiting the top class of employees and not the lower class, and the IRS will come in and limit what you can do. So to get around that, a lot of times we move to Section 2 here, the safe harbor rules. So with the safe harbor, you are telling your employees that, hey, if you contribute up to a certain amount, we'll contribute up to a certain amount. And in exchange for that offer, the IRS will come in and take the testing rules off and say, okay, Mr. and Ms. Business Owner, you offered, the employees did not participate at that level. No problem. You made the offer. We take the testing rules away. Mr. and Ms. Business Owner, you participate at the prescribed levels. In that situation, your safe harbor contribution usually amounts to about 4% of an employee's compensation. So you're on the hook for 100% of the first 3% of their compensation normally, and 50% of the next 2%. So it kind of ends up being 4%. So in trying to budget what that looks like, you're able to take your employee's salary, see if they contributed the max, what your top line exposure is by using 4% of their salary, and you can see what you're on the hook for as far as that goes. Defined benefit, that's when we usually call those pension plans. Of course, those don't exist a lot, but especially at a higher level, your bigger companies aren't doing those anymore because it became too costly, obviously. But there are some opportunities for a small business owner to take advantage of that, and we will discuss that a little bit later. Same thing with profit sharing. Profit sharing adds another layer on top of your 401k plan, gives you an option in years in which you have generated a lot of profit in order to share some of that money with your employees, reduce your tax bill by putting money into the profit sharing plan. The good thing about a profit sharing plan is that it is not a requirement every year. So you do have the option to place money into that plan. So that makes it a little bit more versatile in terms of how you can use it. All right, next let's pivot to kind of some of the again, more simpler things, and we'll talk about just specifically the individual 401k. Most everybody's familiar with the simple IRA, which is kind of an easier plan, cheaper to administer. You have a lower salary that you can put in, so you're capped at 15,500 and 3,500. A lot of times we'll see employers start here, then they outgrow it, step up to a 401k, which is fine. For individuals where it's just a solo person, there are no employees, or it's a husband and wife, the IRS looks at you as one economic unit. So you count as an individual in their eyes. You are able to do a solo K. So back in the day, we saw more of the SEP IRA because it was cheaper to administer. The solo Ks have now become just as cost effective. And their advantage is that the testing rules and the computations are a lot easier. The SEP IRA is, again, based upon profit, and your contributions depend upon that. In that sense, you could over contribute because you have to kind of guess at your profit throughout the year a little bit. Whereas the solo K more works like a regular 401k. You're an employee for tax purposes, for this contribution purposes, and you can contribute 22,500, 7,500. Now, in most setups on these solo Ks, there is an automatic profit sharing plan that is put on top of it. So you do have, if you've had an outstanding year, you actually do have that profit sharing plan that is sitting on top of this 401k, where you can defer some more money into that plan. So that's kind of a quick overview of the main types of plans. We won't get into the government side with 403 or nonprofit side 403B and 457 plans, but they kind of work exactly the same in terms of those limits and things of that nature. All right, next, let's as we move on. So we've hit plan design and features. Cost. So one thing the IRS is doing is they are actively encouraging business owners to set up 401k plans. So what you can expect from that, from a tax credit perspective, the credit is 50% of your eligible startup costs up to the greater of $500, or the lesser of $250 multiplied by the number of non-highly compensated employees who are eligible to participate in the plan, or $5,000. So long story short, you can receive tax credits, which work dollar for dollar against your tax bill, up to $5,000. So the IRS is trying to actually pay for your plan the first few years to get it started. So it's a great time, if you do not have a plan, to look at starting one. So a discussion with your CPA accountant about that is certainly helpful as well. Okay, so that kind of covers the basic things that I really wanted to go over. Some of the plan types, plan designs, kind of what we want to do on a high level. So, but what you guys are really here for is to kind of dig down into tax strategies. What are we doing? How do they impact us? What does it look like? So let's kind of start off with a hypothetical example here. And I'll get this pulled up on the screen. So here I've got, I have an example where I have two business owners. They both are S corporations, and they have decided they have S corp income of $514,400. Exact same income here. Both of them have gone up to the IRS limits for 2023. So we're projecting 2023 here, where the IRS limits, they calculate some numbers in which they say you can make a maximum contribution, and it's 20% of that number. So, and we'll see this again down the road. So pay attention. But you use the number 330, you multiply it by 20%, and you come up with $66,000. So that is the most that an employer can put away on behalf of an employee into an employee's account. So if the employee defers 22.5, they're over 50, they do 7,500, there can be a match in there. We are limited to a total of $66,000 that we can get into the plan, unless you're over 50 and you get the $7,500 step up to 73.5. So that's something we'll get into a little bit later with another example, but we want to start here with this one. This example here is really purely trying to point out the qualified business income deduction. And when you lose that, what happens? And when you pair your 401k plan with profit sharing and a defined benefit plan, how it can save you some money. So in this case, we've got again the S corp income of 514.4. The owner's W-2 salary is 330. This person is married. We're assuming that the spouse doesn't work. And so once we put this into a tax return, we're at a taxable income of 464.2. Now, again, the accountants are well aware of this. For some of us in specified service industries, dentists, doctors, lawyers, accountants, financial people, the IRS, when they passed this tax law for the QBI back in 2017, they kind of put some limits on people in specified service industries. So the limit for 2023 of taxable income is actually 347,320. If your income is above that number, you kind of start to get phased out. So the point of this example was to kind of show that if you have taxable income of 464.2, you're phased out of that QBI deduction. It's gone altogether. Can't do anything. This person over here contributed 22.5, just like this person, but they came in and put another $100,000 into their profit sharing and cash balance plan to get their taxable income down, getting some of that profit off of their books. And by doing so, they were able to get that taxable income down to the 347,320. They got a little bit of a QBI deduction, but look at this tax savings here in North Carolina of what their tax bill did. Tax bill went down $40,000 by putting in that $100,000. Now, again, the key to plan design is we are looking to, as you are the business owner, we are looking to maximize that contribution for you. So when we're trying to break that money up, we want the bulk of that money to go to you. So there are different things that we have to do on the back end in order to look at the plan, look at the employees, look at your census, such that we can design that plan such that the bulk of this money goes to you. And that's key. The business owner is taking all the risk, so it's only fair that we structure it that way to benefit you. So that's the purpose of us getting a lot of data on you, plan, goals, things of that nature, in order to make sure that we have this structured in a manner that best benefits the business owner. Now let's talk for a minute about, because I do have some athletes and sports agents and entertainers that are on the stream as well. Let's talk about some things that they can do. Specifically, the athlete has a opportunity through a special thing in the tax code called a personal service corporation. So what that does is, as opposed to being an S corp, the athlete is able to set up a personal service corporation, and they advantage of that become that. So let me back up for a second. So usually we'll take our most popular NBA person right now, LeBron James. So LeBron James actually is a W-2 person in the NBA for the Los Angeles Lakers. So his own payroll, he can put money into the 401k plan just like we can at our employers, up to those same limits you're looking at, 22.5. He's not over 50, so he cannot do the additional $7,500. That's where he is. So he can put away 22.5. Now, since he is a athlete and quote unquote generates dollars from another source, i.e., his marketing contracts, things of that nature, he can actually look at setting up a personal service corporation, because basically he, as a brand, as we'll call it, can contract with Nike or Coca-Cola or whomever for his personal services. And so he sets up a personal service corporation. He has to pay himself a W-2 through that, just like anybody else. But he gets to run a whole nother retirement plan. So it's a little quirk in the IRS rules that benefit athletes and entertainers. Again, needs to be set up properly. And so it's key to make sure you've got your tax consultant, your tax attorneys, making sure that you set it up properly. Of course, the IRS loves to scrutinize it, but if it's set up properly, it's great. And there are other things that you get to put in there in terms of medical and employee reimbursement plans. You can offer health insurance. So it offers a ton of opportunity for the athlete. But the big thing is we are able to set up a retirement plan, cash balance, profit sharing, all that fun stuff as a business owner, because this becomes that person's business as well. So that's a huge planning opportunity that we cannot miss for those athletes and entertainers. And it's actually coming down quite a bit now, because now we have, college athletes with NIL getting a lot of money as well. So there's a huge opportunity there for tax strategy, tax planning, to assist those clients in those realms. All right, so now let's get into a little more of a detailed example on our business owners. So let me pull this one up and make this a little bit bigger. So this is a checklist that we utilize we like to give it to our business owners, give it to our CPAs that we collaborate with, to help them as they're trying to think through things and find tax savings for their clients. Again, let me hide this for a second. So I consult with a lot of clients as well in the CFO type of mode for them. And I'll pick on my dentist, and they hear this every year from me. And we go through this same discussion about October. So we're in October, we're tax planning, and here we go. We see profit, and the discussion becomes: I have this profit. What am I supposed to do with it? They usually pivot to buying equipment. They're like, "Hey, I got this profit. I need to buy some equipment." I said, let's have a discussion about that. First thing is, do you need the equipment? If there is a need for the equipment, it is going to replace an old piece of equipment. It's going to generate some income. Makes perfect sense. Eventually, you're going to have to do that, buy the equipment. But if we're just buying equipment for tax purposes, that's not a good financial trade-off. And the conversation goes a little bit like this. Yeah, I've got $100,000 in profit. I want to get rid of it. Let me go buy a $100,000 piece of equipment. Okay. Do you need it? Well, no, I don't need it. I just don't want to pay these taxes. So I go, okay, so you're going to spend $100,000 to save $40,000 for a piece of equipment that you don't need. So now that pivots to, oh yeah, that doesn't make sense. And we have that same conversation during tax season. I know all the accountants on the call are shaking their head. Um, that call goes like this: oh, I owe taxes. What can I do? And they want to, should I give more money to charity? And now we have to have that conversation. Okay, you do realize it's not a dollar for dollar savings. So, um, and that is not a dollar for dollar savings. Um, again, you're spending 1,000 to save, if you're in the 20% tax bracket, $200. Again, that the idea becomes to move money from one place to another and get a tax savings, not to spend money. So again, we back up and have this conversation. No, how about we put the money in a Roth IRA? How about if we want a tax deduction, can we put it into a traditional IRA? Have you maxed out your 401k? Things of that nature. We want to keep dollars and spend them responsibly. So again, that's the conversation that we have to have in order to to get clients on board. But let's delve into now this more detailed example. So again, that's the same. We lead through that with this conversation here. Let me make this a little bit bigger, make sure you guys can see it okay. All right, so here's the thing. Do you own a business? Yes. Is the owner paying themselves enough W-2 distributions on January through December? Yes. So basically what we're saying here is you're taking enough compensation throughout the year through your W-2 and distributions to run your household. Great. We do all that, we've still got some profit left over. So what do we do? So the business is profitable even after owner compensation. So that begs the question, what is the strategy? So first thing you do, pull out your profit and loss statement, right? Revenue minus expenses, including the owner W-2 and distributions. This is really your net profit from this business that you still have left over. Now we got to do something with it. You can kind of see here, this is set on 2023. So again, if you switch to a simple IRA, you've got 15.5 that you could have put away. Or we've got these three buckets here. And so let's see how this works. So again, we set up a 401k plan. And oh, by the way, we do a safe harbor 401k because you as a business owner are an employee as well. So you have to match yourself. So let's look at this math here. So we got 22.5. Again, if you're over 50, you can put in the 7,500. The match is usually somewhere 3-4% of your W-2. We got a profit sharing on top of it, as we discussed earlier. Get this out of the way. All right. So here's an example: 200,000 KW2 with a 4% match. So that person as an owner is putting away 22.5 out of the business. The business put in 8,000, which is a deduction. So now we've got $30,500 going to that owner. Now we've got 35.5 left in profit sharing we can do to the owner. But let's take a deeper look at profit sharing. There are two issues. One, profit sharing can be too expensive if the owner has to give more to the employees than to Uncle Sam. So again, we're doing a cost benefit analysis, running numbers. If we put money into the profit sharing plan, it reduces our taxes, but what are we giving to the employees versus what are we giving to Uncle Sam? So, because you do have to be fair in that distribution. So this is what can cause the profit sharing plan to be more costly for the employer. Now, keep in mind what we're trying to do is get about 60 to 70% of the total contributions to the owner. Again, we're trying to design this plan to get most of the money to the owner. So in this situation, the owner can put in 35.5, but he has to give 30K to employees. So the owner's only keeping 47%. So the way the numbers worked out for this guy's census or female census, business owner in this case, that's probably not what we want to do because we're not getting the bulk of that money over to the owner. But if the profit sharing works, but the bucket's not big enough, so here's a different situation. Again, the owner can put in 35.5, but there's only 15 left to go to the employees. So now we've done a pretty good thing because the owner's getting about 70% of the money. So again, that profit sharing, the beauty of it is it varies from year to year. So you don't always have to do it. So that is very helpful. I got to give my business owner some flexibility. I don't want to put them in a box where they have to do something. Um, all right. So again, we've kind of talked about this. These are things that we can do with additional profit. Unfortunately, we kind of talked through the first four things first as individuals. Um, do we reinvest into depreciating assets? Only if we have to, right? We can pay Uncle Sam, pay down some debt. Not a bad idea. Pay Uncle Sam and invest. Okay. Pay Uncle Sam and spend it, or save all or some for pre-tax. All right. So let's get into this cash balance. So now we're in the bucket 4, the cash balance plan. Cash balance plan gives you some other options. So if the profit sharing is too expensive, it's not a big enough bucket. What the cash balance plan does is it allows for 6 figures of pre-tax savings. The owner, in this case, usually keeps 80 to 90%. Okay. Money is deducted from corporate return versus flowing through to the personal tax return, saving 30 to 40% in taxes. The money can be invested and or a portion can purchase life insurance. So we've got a few more things we can do with this cash balance plan. So again, in this case, the owner gets paid 200K plus 50K quarterly distribution, 400K total. He deferred 22.5 plus 8,000 match. So the business has net income profit of 350K. The profit sharing works, but the bucket wasn't big enough. So we weren't able to get that percentage we want, that 60-70% that we want. So we need to pivot over to a cash balance plan. So in this example, we're going to assume 250K to the cash balance plan, and we take home the other 100K. Remember, we had a 350K of profit. So we have to give the employees about 50K, but the owner keeps 200, 80%. We get a full tax deduction on the 250. That saves us 100K in taxes. So net savings of this transaction is 50K. So therein lies the beauty of stacking these different plans on top, cash balance, profit sharing, things of that nature, in order to save on taxes and build wealth. So look here, saving 200K versus 30,500. That's 6.5 times more we're saving for retirement. So now we're building wealth as well versus putting money in depreciating assets. So again, people, make sure you've got plans in place. I know, I mean, you got to think strategically. You got to think ahead. You really got to kind of roll up your sleeves and get with some professionals, your CPA, and dig deep into the numbers, what you want to happen, and kind of go from there. Those are the things that are really going to set you apart and help us manage these taxes, manage this cash flow, and set you up for success. So again, that's the part about what I should be paying attention to. Now the key thing is, how do you kind of get started? Where, you've identified, hey, I've got some things going on with my plan. Maybe it's not operating the best it can. Maybe I just need to get one started. What can I do? I can certainly conduct fiduciary reviews. What we kind of generally ask for, these things you see on the screen. We need your fee disclosures. We need the participant fee disclosures. They've got some official names here. And we need your plan statements so we can look at your fees, your expense ratios, things of that nature. At that point, I kind of go into what I call the lab and go into crunching numbers, putting in your plan assets versus a proposed portfolio, looking at fees, looking at costs, looking at performance, looking at risk, looking at how the plan is designed. Are we maximizing, again, these tax benefits? If the plan is, again, kind of a smaller, closely held company, and we're paying fees out of plan assets, but the owner has the bulk of the retirement assets, let's pay those plan assets out of the business cash flow, because now we can get a tax deduction. When that money comes out of plan assets, it doesn't hit your bank account. The accountant can't deduct it. But when those fees come out of that cash flow come out of your bank account, it becomes a legitimate retirement plan expense that can be deducted for you. So we need to look at little things like that, can kind of, because you're paying the same fee, you're just not getting credit for it because it's coming out of the assets, which is also depleting your assets. So again, a couple things that we have to pay attention to there in plan design. So we ask for all these things in order to drill down onto designing that plan for that business owner, making it work, making sure it's optimal in what it does. Um, the other thing is, you are, as plan sponsors, you're actually required to have these fiduciary plan reviews done at least every 3 years, and checking on your fees every 3 years. So, again, by getting with myself or Jacob, to have a fiduciary plan review done, actually, we're going to give you that report. You get to put it in your review file that say, hey, I reviewed my plan. They looked at it. It's okay. We're going to keep going, and you've met your fiduciary responsibilities as well. But a lot of times we kind of jump in and be co-fiduciaries with you with the things we do on the back end in terms of monitoring those plan assets. We're looking at different criteria to make sure the investments are still performing well, and we're pulling them out if they're not. If they're not performing, costs are going up. We're having to pull those things out. One, to protect you as a plan sponsor, and two, just to increase performance. So at the end of the day, those are things that you can do to help your clients, the account CPAs out there. I think we've got bankers on the call today, kind of a lot of people, realtors, other advisors are on. So it's just been great. I really appreciate everybody jumping on to kind of watch these things and learn about how they can benefit themselves, how they can benefit their clients. And that's what we're really here for, is serve our clients, make sure we're doing the best things we can do for them to get them to be successful. So at the end of the day, let me kind of close here. Again, this one was not on our schedule for this year, so we kind of threw it on here because we're in the middle of tax season. I know I'm getting a ton of calls about tax savings. I've spoken with, I know James Hayward's on the call. He's had a lot of these questions on what we can do to help clients and get down their tax bill. So these are just things that we just run across all the time, and want to help people. My contact information is going across the top of the screen there. You can visit our website again at friarfinancial.com. I'd love to get these documents out to you, so please reach out to me so you guys can have a checklist of the different types of retirement plans, the checklist to go through with your clients. The examples there are really kind of helpful to make sure you understand the mechanics behind it. And I'm here for phone calls, so certainly you guys have other questions, unique situations, especially those agents that are on the call with NIL, helping those athletes, getting them on the right path early in life is crucial, and just teaching them financial concepts. So again, thank you all for participating today. Yep, unfortunately Jacob wasn't able to make it. He did text me, said he was a little still tied up. We are back next week, same time, next Tuesday, delving into insurance basics. Have a State Farm agent out of Raleigh, Jackie Newkirk, whom I've known for many, many years from my State Farm days as a claims rep. Who was a claims rep in Raleigh in 1992 to 2000. So known her, at least 22 years. But she will be on next week with me as we'll delve into auto, home, umbrella policies. Probably get into some business stuff, some policies that you haven't even thought about. Employee dishonesty, big thing to have as a business owner. But at any rate, that is it for today. Again, I thank everyone for taking the time to join. Hopefully this information has been helpful. I hope to hear from all of you, and love again to just get information out to you. Any way I can help you, help your business, help colleagues, help clients. That's what we're here for. So, again, thank you, everyone. Have a great evening, and please join us again next Tuesday. Again, these streams are on this page, my LinkedIn page, my Friar Financial Facebook page, and we do have a YouTube page. So again, feel free to share. Um, they're recorded, so they're there for everyone. And make sure we're sharing information, and we'll get as many people on the stream as possible. All right, until next Tuesday. Thank you all. Have a great day.